Right, realise I'm between you and the next cup of coffee or piece of cake or whatever, so I'll try and be as brief as I can. And obviously, a few exciting presentations that I'm following, so it's a bit of a challenge. But anyway, so the billing is a finance update and a budget update. So I'm going to talk about the forecast that we put together for the board for our financials to the end of the year, an overview of the budget for 2026. And those of you who think that I'm talking about the UK's budget, that's next week, and I haven't got any insight on that. And then obviously any questions from you. So first of all, 2025, we've, as Jen pointed out, we've had a modest but reasonable number of increase in membership. We're always keen to get more members. The more members we have, the more we can effectively provide a better service to everybody. We've had further growth in peering capacity per member. So I guess we've had very good growth in 400G, which is an important part of our growth plan. And overall connected capacity went up 17%. So all these things are really important in terms of spreading the costs over a broader base, and that gives better value for members. We had a decline in 100G, which is partly a substitution, people moving to 400Gs, and 10Gs is obviously going down as people are moving to larger capacity. A good take-up of some of the things that were introduced in 2025 of 50G and the repricing on 30G. So there's good progress operationally. What does that mean for the numbers? So we've made good progress against our strategic objectives. We did hope for and plan for slightly higher revenue growth. So we're behind on budget on that. But despite that, the costs have been tightly controlled. And I'd say the shortfall was largely due to peering revenue being lower than expected. Some of that is our own strategic success of switching people to 400G because people have been cancelling some 100G, moving to 400G. And in some cases, that reduces the revenue we get, but it's where we want to go directionally. The other thing is, of course, we agreed a price cut on port access, and there were other sort of some freer services. So that's meant that had we not done that, our growth would have been 7%, but it's been about 4%. So it is growth, but it's not quite as much as we were hoping. In other areas, we've had good growth in managed IXP, but the overall result was gross margin slightly lower than last year. We continue to invest for the future. And again, I think we're always dealing with fine margins in the business because as a not-for-profit organization, we're sort of budgeting break even. It looks like we'll have a small deficit because of the shortfall on revenue. But nevertheless, the operating cash flow should be higher than last year at 2.7 million. I won't go through all that again, but basically you can kind of see there that we're expecting 4% growth in revenue. Costs went up, but actually below our budget. But as I say, that these are very small deficit as against last year was also a small deficit, but we were budgeting to be pretty much break even. So in terms of next year, we're building the budget, or we built the budget in line with the 3-year strategy that Jen talked a little bit about. We're planning growth of 8%. Again, it might be ambitious because I would say the background economic conditions are still pretty challenging globally. So we hope to grow, but we can't obviously promise that. Obviously, I prepared these slides a few days ago, and outlook for inflation is low. It's good to see this morning's announcement that inflation is coming down a little bit. Not hugely, but a little bit, and that obviously helps in terms of managing costs. Interest rates also have been reducing. We shall see what happens in December, but hopefully for businesses that are investing, that's good news. So we're budgeting overall a small surplus of pretty much break even, but 0.1 million positive we hope to do. In terms of what this means, sort of underlying capacity in members, we're only budgeting a modest growth in members, but maybe it'll be higher than that. And connected capacity, we're planning 16%. So obviously, the more we build, the more we can spread those costs, as I said before. So I think in terms of the peering, although it's been very flat in 2025 on a revenue front, we are expecting that to pick up next year with particularly 400G, 30G and 50G, and also, as was announced recently, the new 130G and 150G. I know, James, we don't have all the numbers you want, but hopefully providing some of those intermediate ones will help grow and satisfy some members. Again, we're targeting a similar gross margin level, which is solid, and expenditure we're trying to manage pretty tightly, always focusing on cash. Again, in the interest of times, I won't go through all of that, but you can see all the points here. In terms of revenue growth, overall 8%, but peering, which is obviously still our core business, we're projecting 5%. And again, this sort of ties in with what Jen was saying about trying to diversify the revenue, grow it, but diversify and not rely just on one source of revenue. And particularly areas like managed IXP and Fabric, again, that Mike was talking a little bit about. That's the area where, although it's a thin sliver of the cake at the moment, we're hoping that will grow by a third next year. Costs, obviously, we can manage a bit more tightly than we can manage revenue. And we're expecting costs to grow by about 5%. Some of that is just inflation. But there are areas where the costs are going up slightly higher than inflation, particularly areas like security, compliance, regulation, and also we're doing a bit on automation. So again, as I said before, projecting to be pretty close to break even. But we continue to invest, and obviously we have choices if we generate operating cash flow, and we're going to plan, but we're not committed yet to spend slightly more on CapEx, number of projects. Manchester refresh, again, Manchester was mentioned earlier on the strategy. LON1, which is again in our core revenue stream, often needs capacity upgrades, and we don't ignore it just because it's doing well. Plus, obviously, there's some overseas expansion. But we also spend internally on software systems, automation enhancements, and essentially trying to create more capacity with greater power efficiency to play the green card as well. So yeah, but the key things, as ever, very high levels of recurring revenue, good cash generation, happy CFO. So that's all I'll say. But if there's any questions, preferably easy ones. Oh, there's a question over there.
Hi, James Rice, Jump Networks Limited.
Oh, good. Sorry, James, you're the first question, I think, ever at a CFO.
Excellent, okay.
Yeah.
Well, because you directed one of your comments at me, I wanted to respond. I think there's been a bit of a misunderstanding in that you expected what I was looking for was more and more tiers of rate-limited ports, and the answer is absolutely not the case. Having more tiers of rate-limited ports is just a sticking plaster on a completely obsolete pricing model. It causes more congestion or more drops, more traffic harm on ports, because it means that you end up with everyone running close to the headroom or with no headroom and traffic getting dropped, and it's harmful. It is not a good way of doing things. We need burstable ports. Otherwise, you're just causing traffic harm and driving traffic away from the exchange.
Okay, I hear you. I don't fully understand it. I understand what you've said, but I will leave it to my fellow colleagues on that. But yeah, I understand. Yeah. And I wasn't trying to be trivial about it. I was just explaining there are more options because we do listen to other people about where they wanted the capacity. But I take your point that it's the burstable aspect. Yeah. Any financial questions? Or? No, not seeing any hands. Right. Thank you very much.